Just in case you were getting too comfy at the cottage, China offered up a summer storm, a 1-2 gut punch of currency devaluation. What has followed is a wave of reaction that has still not settled down, and a lot of speculation as to China's rationale for the move. Opinions are varied. Was this a competitive devaluation aimed at shoring up an ailing domestic economy by boosting trade? Or was it just time for a renminbi reality check? One thing is for sure, it took the world by surprise. Few, if any, saw a change to the relatively stable path the renminbi has taken since early 2014. Thus, the 1.9% drop against the US dollar on August 11th and the further 1% the following day, the largest swing since August 2005, rocked markets. The speed was perhaps more shocking than the actual amount of movement, but the real jolt was the departure from a steady and predictable currency management program which had been in place for nearly 2 decades. What happened? We don't have to look too far for reasons. The first is China's quest for an internationalized currency on par with the US dollar and the euro. This goal has led to the setup of renminbi hubs around the world, including Canada's last March, a series of financial reforms that are pushing the renminbi toward full convertibility, and a concerted effort to have the currency added to the IMF's special drawing rights basket. The latter would vault the renminbi much closer to a global reserve currency overnight and greatly augment its worldwide circulation. In fact, a key but largely unappreciated development last week was the People's Bank of China's move to allow the previous day's market close rate to influence the renminbi's daily fixing rate. In other words, the invisible hand now has a seat at the table. Beijing is signaling that its renminbi internationalization agenda is alive and well. Another reason is the reality that the renminbi's existing valuation mechanism was no longer sustainable as it was too closely pegged to the US dollar. While the renminbi is officially pegged to a basket of currencies, and the exact formula is not really known, it is clear that this basket is heavily weighted to the US dollar. The bilateral rate did not fluctuate more than 2.3% in the past 20 months, while at the same time, America's trading partners on average depreciated 18% against the greenback. Well, this has effectively caused the renminbi to track the rhythms of the US economy rather than its own, while structurally and operationally the two economies are worlds apart. Thus, China's currency actions have punished its trade activity this year, favoring instead economies whose currencies have steadily weakened. Current industrial production and export numbers seem to corroborate this scenario. Take China-EU trade as an example. The EU gobbles up 15% of total Chinese exports, and in the past 20 months, the renminbi has appreciated 18% against the euro. The same can be said for its standing against other significant trading partners. Analyze the reaction of any economy to currency swings like this, and it's pretty hard to stem steep declines in activity. This also happens at a time that China's internal cost structure is rising against other low-cost producers. Weighting the renminbi to trade activity suggests that if the currency were indeed free-floating, more depreciation likely would have occurred. By this measure alone, further renminbi depreciations are likely warranted. There are, however, more factors that determine currency values. Certain balance of payments data suggest that China's resilient renminbi looks reasonable, although a proper assessment on this basis requires a broader sense of financial assets and liabilities across the Chinese economy. China's real effective exchange rate produces yet another assessment of where the renminbi might belong. Suffice it to say that the true level of the currency continues to be hotly debated. The bottom line? Accusations against China of competitive devaluation at this point seem short-sighted. It's actually more surprising that given its structure, China's currency has not depreciated more. And if that is a near-term possibility, then we can expect the consequent market volatility to persist. Until next week, I'm Peter Hall.